In order to be considered a valid captive, you need two things: risk distribution and risk shifting. In this one, we're going to be specifically talking about how some captives do risk distribution through the use of risk pools. Hi, thank you for watching. My name is Wes Sirk, and I'm the president of Risk Management Advisors, a risk strategies company. And in this video, we're going to be going through what are the dangers of risk pooling in captive insurance arrangements. So I got the idea to shoot this video right now as I just got off the phone with a CPA in Chattanooga, Tennessee. She has a few clients going through IRS audits on their captive right now. Their main sticking point and their main contention is risk pooling, and that's what the IRS hung their hat on to disallow the deduction for these clients. And in my discussion with her, I said that's not really an issue for a lot of our clients because although they share risk amongst each other, there are different ways to do risk pooling. And she said, do you have anything written on that? I said, no, but I'm going to hang up the phone and I will record a quick video to tell you so you can, when you're talking to your clients, you'll be able to understand what is the difference between different risk pooling structures and what the IRS likes and what the IRS doesn't like. Increased premiums across many different industries has led to a recent growth in captive insurance company formations. We see a surge in the middle market that are looking for an alternative to the increasing premiums that they're facing every single day due to this hardening market. The IRS says in order to be considered deductible, captive insurance needs risk distribution and risk shifting. Risk shifting is pretty easy because it says just taking off the balance sheet of one company and putting it onto the balance sheet of another. Risk distribution is a much more subtle or nuanced thing to discuss. Risk distribution is based on the law of large numbers. Traditional insurance companies have many different policies, many different clients over many different countries. Their risk is distributed. One event here doesn't take down the entire company. So if a client has a small captive insurance company, it may be difficult to satisfy this law of large numbers concept with their own captive insurance company. There are many different options that are available to the captive owner, and many of them participate in what we call a risk pool. Many different captives come together and their risks are blended and shared amongst each other. So in a risk distribution pool, clients pay money to their captive insurance company. According to the IRS Revenue Ruling 2002-89, their safe harbor is the captive must have 12 or more separate entities insured or 50% third-party risk. So we're going to specifically talk in this video about the 50% third-party risk. For 50% third-party risk, what the client's captive has to do is it has to take in premium dollars, and in most scenarios, it gives off 50% of its risk to other captive insurance companies. And the reason we call them a risk pool is in many cases, this goes to another insurance company, which acts as a pooling mechanism. So let's just use 100 captives. 100 captives take 50% of their risk and put it into the pooling captive. They then take a percentage risk back from the pool back to their own captive insurance company. In actuality, the way it works is, let's say you had 100 companies paying $1 million in premium. The captive would take $500,000 of their premium and put it into the pool, and then they would take out $500,000 of risk. And that's risk that's unrelated. The risk that they take back wouldn't have any of their own risk. Now we're going to get into where the IRS sees trouble with risk pools. The IRS's main issue with risk pools is the risk is never really distributed amongst all of the different members. So the risk pool has to be independent. It needs to be run separate from the members, has separate books and records, and the captive manager must be able to show that there's a sufficient number of people inside that pool and that all of the claims are treated fairly inside the pool. In recent tax court cases, what the IRS has said is that the pool only exists in name only in order to distribute risk. The pool itself isn't really taking any risk in these transactions. I'll give you an example. In a traditional risk pool, a captive pays 50% of the premium to this third-party entity, and then the third-party entity simultaneously gives them all of their money back from risk from somebody else. And it's kind of a wink and a nod agreement that no one is going to submit any claims. You know, in the Abrahami case, and there were 3 other tax court cases, the IRS was able to say that the risk pool really wasn't a pool because no claims were submitted and no claims were paid out of the risk pool. Another area that the IRS dislikes is the area of 50% risk. Some captive managers have taken that to mean if you have $1 million policy, that the captive takes the first $500,000 and the risk pool takes the next $500,000. So it's an excess of loss. But that doesn't get to what the IRS really wants, which is these companies to be sharing risk. The IRS said specifically, the risk for the first $500,000 of the claim is a lot more expensive and a lot more probable than the second $500,000 of risk. So a design we like is the same as every major insurance company in the world, and that's a reinsurance treaty. That's insurance companies going out and getting treaties with other insurance companies. You would never see Lloyd's of London, Zurich, Liberty, all taking a bunch of their risk and giving it to one entity that then pools all the risk together and gives it back to them. No, they sign reinsurance treaties with a lot of other insurance companies. So a reinsurance treaty that we like for captives is, let's just make it easy and say there's 50 captives. Captive A that we're talking about goes out and signs a reinsurance treaty with B through the other 49 insurance companies. There never is one entity that the IRS can come in, because that's what they've been successful in doing. Let's use Artex. And I'm not saying Artex was right or wrong in any of their captive audits, but what the IRS was successful in doing is saying that the risk pool itself was not valid. So therefore, any captive that pooled the risk with the risk pool is now not valid because they don't have 50% third-party risk. So that's just a really quick overview. There's certainly, we can dig down into the weeds for this. But to summarize, there are many risk pool structures. The IRS doesn't like risk pooling. And there are some very good reasons why most risk pools will not survive an IRS audit. A much better structure is to use a reinsurance treaty where the companies are giving their risk to other captive insurance companies and assuming risk from those captive insurance companies. And it's very important it happens at $1, because the IRS said, in the same way we use the example, if a captive has $1 million policy, taking the first $500,000 in a claim in the captive and then laying off the excess $500,000 to another captive, the IRS says they don't like that. But it's a very strong set of facts when you're in a treaty with 50 other companies, and let's say your captive has a $10,000 claim. Well, your captive pays $5,000, and then the other 50 captives pay their pro rata portion of that other $5,000. That way, it's all done above the board. It gets to exactly what the IRS wants, which is risk distribution. Your risk on that $10,000 claim is distributed. 50% of it is paid for by other companies from $1. You don't have these artificial deductibles. You don't have half of the claim being paid by another company. Thanks for watching. My name's Wes Sirk. I know we went through that quickly and you probably have some questions. Don't hesitate to reach out. If you have any questions, put it down below. We will answer your questions. Questions, comments, concerns. If you say, hey, Wes, you're out to lunch, this doesn't really matter. Or you're way too conservative, we love to hear it. We recently redid our 2020 Ultimate Guide to Captives. If you'd like a copy of that, and it goes through risk distribution, risk shifting, what does the IRS say in Revenue Ruling 2002-89, please put a comment down below saying you'd like a copy of the Ultimate Guide to Captives, and we will make sure we send you a direct message with the link so you can download it and get that information. Once again, my name's Wes Sirk. I'm the president of Risk Management Advisors. Thanks for watching.